Hi, it's Brian again. Today we're going to start talking about indicators. Indicators help you look deeper than just the price of a commodity or a currency and help you predict when a good time to buy or sell may be. The first indicator we're going to take a look at is the simplest, but for many people the most effective. We'll be exploring a moving average. A moving average shows the average price for a chart over a set amount of time. A moving average is used to smooth out price fluctuations and help you see emerging trends in the price data. Let's look at a fictional example real quick. Here's a fictional chart representing the value of a fictional currency pair. The axis on the bottom represents hours in the day. Let's look at 3 p.m. in the afternoon. A simple moving average with a period of 5 would take the average of the previous 5 hours of data. Let's do the math. The value at 10 a.m. was 5, 11 a.m. was 7, 12 p.m. was 3, 1 p.m. was 5, and 2 p.m. was 7. The average of these values is 5.4. So the moving average at this point in time is 5.4. Let's move ahead 1 hour to 4 p.m. To calculate this moving average with a period of 5, we'll now disregard the 10 a.m. value and add the 3 p.m. value to the calculation. The moving average is now 6. Get the idea? There are several different kinds of moving averages. The one in the previous example is called a simple moving average. Another common one to see in the trading world is an exponential moving average. It's calculated similarly, except that as the values get older, they're weighted less in the average. The two types are used in different situations for different things. One is not necessarily more useful than the other, just used in different situations. Now let's look at a real-life example of a moving average to see how they can be used. Here's a chart for the last month of the currency pair Monero versus Bitcoin, XMR BTC. Let's add a simple moving average with an arbitrary period of 50 to see what happens. Now, do you see what I mean by the moving average smoothing out the price fluctuations? When the price made its most impulsive rises or drops, the moving average was relatively unchanged and showed a truer picture of the overall trend of the currency. Another thing that you should notice is that the moving average seems to be a good indication of when the price is going to drop or rise. It seems like the price of the currency pair always eventually goes back to the moving average. When it's above, it might be a little overpriced and eventually falls, and when it's below, it might be a little undervalued and eventually comes around and rises. Now let's take a time out real quick. You'll hear traders say things like I just said all the time. They'll act as if the price of something responds to some indicator. Based on what we know about moving averages, we know that's not the case. Think back to your high school algebra class. The price of the currency or commodity is the independent variable, meaning it moves around independently of the other variable, the moving average, which is the dependent variable, meaning it's dependent on the value of the price to calculate its value. This is all to say that the moving average follows the value of the price, and not the other way around. However, you're still going to hear traders talk like it's the other way around, and the price value is some intelligent force. It's not. That's just how we communicate some of these abstract concepts. You'll know what people actually mean. Just let them talk incorrectly and move on. Now we know when the price is undervalued or overvalued, and we can identify good times to buy or sell. For example, the thing that pops out the most of this on this chart is this would have been an excellent time to create a short sell. Eventually, the value went down to the moving average, and you would have made some money there. Conversely, this would have been a great time to buy. Eventually, it went back up to the moving average, and you could have made a nice little profit there. At the time, this seemingly might have looked like a good spot to sell, but had you done so, if you would have waited to get out of that position until we reached the moving average again, that would have been a bad position. So really, we can only know for sure when we look back in hindsight when the best times to sell or buy would have been, but the general trend rings true that eventually it gets back and crosses this moving average. There are many, many other indicators out there that we'll be talking about, but honestly, moving averages are one of the time-tested linchpins of most trading strategies, and most traders can do quite well with them. Now that you know what moving averages are and how you can use them, go out there and try some. I've got videos that should be popping up right around these spots to show you how to use moving averages on a few different trading platforms. Choose the one you're using and let's get to work.